Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, October 26, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And the Spider was up about 25 cents today from yesterday's close. It is up higher in the aftermarket or after hours trading as a result of some earnings announcements, which we'll get to in a minute. I want to discuss that briefly. We had Google, Amazon, Intel, Microsoft, and several others. So it was a big day for earnings, and that could certainly impact tomorrow's market. But let's discuss what happened today, and then we'll get to that in a couple of minutes. So all in all, not much activity today in the market. In fact, when you go over to an intraday chart, you'll see that we traded, and you can see here even on the daily chart, we traded in a very narrow range today. And when you look at from the open to the close, basically we gapped up a little bit at the open, and we basically put in just a sideways bullish pattern from yesterday's close. This will generally promote another move higher, and that's what we're seeing in the aftermarket session. So I just wanted to point that out. But all in all, today there was not a lot of activity in the market. In fact, the volume was significantly less than yesterday's volume. That was right around 100 million shares. Today we were at 68 million and change. When you look at the down activity yesterday and the pickup in volume, you can see where the institutions begin to participate in the market. Today the market was very quiet. There was not a lot of activity, not a lot of volume out there, and we traded in a narrow range pretty much all day long. Now, I will say that if we do take out the highs from the 23rd, let me just move this chart over. If we take out the highs from the 23rd and the high was 257.51, that's going to promote higher prices. And when I say take out the highs, I mean on a closing basis. So we've got to close the day above those highs, and that'll be another breakout to the upside underway. That's what the probabilities would tell us. Before we get to the other markets, I do want to discuss some of the earnings that came out after the bell. So the first one we'll take a look at is Amazon. And when you look at Amazon, and I'll bring the 60-minute chart so you can see the aftermarket activity, we're all the way up at $1,050. So we closed the day all the way down here at $970 or whatever it was. And you can see we're trading about $77 higher in the after-hours session. If Amazon stays up there, it's certainly going to impact the markets tomorrow. It's going to impact the NASDAQ market in particular. It is a pretty remarkable move after market. So we look at Google, and we'll look at Google L. And Google L is also trading up about $40 in the after-hours session. So the market liked the earnings of Google. They liked the earnings of Amazon. And those two in particular can certainly impact the NASDAQ market. So the NASDAQ composite was actually down 7 points today. But when you look at the NQ, the NASDAQ 100 futures contract, you can see here that after the market closed and after those companies reported earnings, we went from below 6,040 all the way up to 6,085. So that's a 40-point move, and that's going to certainly impact the NASDAQ market tomorrow. So we'll see what happens. What I just wanted to briefly discuss, for those of you that pay attention to earnings or don't pay attention to earnings, what we deal with is earnings expectations. And when you have 30 or 40 analysts that cover a particular company, Amazon or Google or Microsoft or Intel, there's tons of analysts that cover these markets. And the earnings expectations is, generally speaking, an estimate or an average of what those analysts' expectations are. So it's not really like there's some number that's the end-all, be-all of earnings. It's a culmination of all the analysts' expectations. The company reports, and then the market decides if it likes the earnings or not. And you've seen this 100 times. We could wake up tomorrow morning and Amazon or Google or any of those companies that were up in the after hours today can certainly finish down by 8 p.m. tonight when everything shuts down, or you wake up in the morning and something else happened and the stocks are down. I don't know exactly what's going to happen. I have no idea what's going to happen by the morning. I'm just saying that the earnings expectations is more like three-card Monte. You never know which, shell it's a shell game, which shell the little round marble is underneath. With that being said, it's just the way the market decides they want to take the stocks after earnings. And all we can do is decide where the support levels or where the resistance levels are for those stocks. And whichever way the market takes it, it takes it. And that's why it's really more or less a fool's game trying to buy a stock or sell short a stock into earnings, because you really just don't know how the market's going to react to whatever the numbers are. We've seen it 100 times. The company reports earnings, the market loves the earnings, and all of a sudden, an hour later, the stock is down and they're telling you why the earnings weren't good. So nobody really knows anything. It's just a reaction. It's an emotional reaction. And right now, the reaction in the NASDAQ stocks, in particular Google and Amazon, are markedly up in the aftermarket session, and that's also bringing the NASDAQ futures market the same direction. We'll just see what happens tomorrow. Let's go back over to the IWM, and we'll continue on with the normal markets that we cover. The IWM was up earlier in the day, traded up into the 20-period moving average, and was rejected from that point, and we still finished up on the session about 1/4% or 36 cents. So all in all, again, a narrow range day, no conviction one way or the other, certainly no volume one way or the other. If you look at the volume from yesterday, which was over 22 million shares in the IWM, today was slightly over 15 million shares in the IWM. And, that's a significant difference. We had a lot of volume on the down day, not a lot of volume on the up day. The path of least resistance in light volume happens to be to the upside, so we did see a lift in the IWM today. But nothing really changed from the pattern, nothing really changed on the IWM daily chart for the most part. Everything that I discussed last night remains the same. We're still inside the bullish pattern above the 148.08. That's bullish for the IWM. The real tell is going to be where October closes for the IWM. Do we close above or below this upsloping trend line? That's going to be extremely important for the IWM. Let's go over to the transports, and the transports had a nice healthy up day today. You can see where the top of today is, almost challenging, really within a fraction of yesterday's high, and then we sold off, but we still finished up almost 1%, 91 points in the transports. So the markets are whipping back and forth, and on a short-term basis, if we stay inside of this down day from yesterday, inside on a closing basis, the top of this red candle, that's going to be another short-term bearish pattern that could potentially play out, or would normally play out, to the downside. We challenged the top of that today, was rejected. We finished below the 20-period moving average, but all in all, a decent up day for the transports, however, still inside of yesterday's large down day. Certainly not making it easy for anybody to forecast the next likely move in a market like this. When you have a big down day like this and another up day the following day, or an up day the following day, up almost 1%, hard to get a read day by day what's going on. So when that happens, I always like to go over, not the monthly, I like to go over to the next larger time frame, which is the weekly chart. And you can see here on the weekly chart, there's really nothing wrong from a weekly perspective in the transports. We can certainly come down farther, but for example, if we stay, let me move this over. If we stay inside of this green candle, which has a low of 96.44 and change, that still has a bullish tone to it and still maintains the last large green up candle and maintains this bullish pattern that we've been making. We've just really been going sideways on the weekly chart, week over week over week on the transports, above all the moving averages. And as long as we maintain this pattern above the moving averages and in this upper range here, this is a bullish pattern that will generally promote higher prices. You see, this is just trading in this range, and we haven't even got down to test the lower portion of the last green up candle. So there's no doubt about it that the weekly chart is bullish on the transports. When you go back to the daily chart, you can see the back and forth up and down behavior, that's really just a bunch of day-by-day noise in the market. So when you go to the larger time frame in the weekly, you can see that really it's just a bullish pattern. Let's talk about the gold market. We don't need this anymore, and you can see how the gold market is now coming down. So yesterday we discussed that the fact that they couldn't really stage any kind of a rally or a bounce off of this gap fill level that we had from the other day. We tested it like 3 times, and I was suspect that we were going to be able to rally in the gold market, and lo and behold, we are coming down, and we came down basically to the 200 period moving average on the daily chart today. Now, I don't consider this level much of an important support level, only because A, we came close to it right down here on the 6th of October. We rallied off that level, or above that, from above that level, and now we're coming back into that level. It diminishes the importance of that level because we came close, and we don't really want sloppy seconds. I don't think this level is going to hold. I think they're going to A, come down and retest the 1262 area that was seen down here, 1262 spot 80. Remember that gap fill? That was 1262 down here in that neighborhood. So we filled that gap over here, and then we rallied up, but we couldn't get past this point here. We filled this gap up here, and we have another open gap at 1303, but now we've come back down, and the velocity is really to the downside at this point. And if 1262 doesn't hold, if this pivot low doesn't hold, then I think this is going to come all the way down to the $1,248 level, give or take, and I think that would represent an interesting area that you should see a bounce from or off of. You'll probably get a bounce off of this pivot low down here, right at 1262 and change. That's the likely scenario, but if that doesn't last and we close below that level, it's going to be a pretty easy shot all the way down to 1248, maybe 1250, but I think it's 1248 in this general zone. So we'll see what happens with the gold market. We did discuss last night that I was really suspect trying to rally off these levels. It really wasn't able to, and to me that said that it was going to melt down, and we are melting down as we speak. When you look at silver, it did look better on the chart than gold last night, but as we discussed, they do trade for the most part in tandem, and we're seeing silver come down as well. The likely scenario is they're going to want to retest that 1640 area, this pivot low down here, maybe slightly lower than 1640 where this pivot low is. I'll just move that down. And if that doesn't hold, then 16, right around 16, maybe a pierce through 16 looks like the number. Right now, to me, the short-term trend in gold and silver seems to be to the downward direction. I know some of you like the GDX and the gold mining stocks, and therefore we'll just give it a flash tonight and talk through it. So usually what you see with GDX is it generally leads the metal itself, and this is just really relating to gold. So these are the gold mining stocks, and what happens is you'll see a move in GDX come ahead of the metal. And you can see here that once we got below 200 and the 100-day moving averages, when we closed below that, you can start to see that it was really struggling, and we didn't even make much of an attempt to hold this green candle low that was at 2250. And today we closed below that level. That is a bearish sign, and that will generally promote lower prices. 21.5 potentially, even maybe 22, but I think the better level is really all the way down at 21.5. That's going to be an important level for GDX. If we do see the further downside we discussed in gold, I think we're going to see GDX all the way down at 21.5. That level would be interesting to me. I would have a tough time being a buyer before that level unless we saw some kind of reversal take place. But today's down day was on some kind of volume, not tremendous volume, but certainly a little bit better than yesterday and certainly more than the average. So the pressure right now is to the downside in GDX. All right, looking over at the bond market. Bonds continue to come down. And remember, we were talking about, before this bounce, we were talking about this level as important. Yesterday it was important, and today we're now retesting that again. and I don't think that's going to hold. That's my take on the bond market. I think the better level in bonds right now happens to be, and I'll just draw a line in there, happens to be right about, give or take in this zone. Whether or not we actually get there remains to be seen, but that is the better level where I think we'll see some kind of a bounce or reversal from that level. That's the better level to me, and that's all because of this here where we didn't come down to this level here that I thought we would originally get to. Had we got there on this shot, then I think we would have seen a much better rally. What we saw was the bond market go up, fail, and because of that, we're coming down with some velocity, and I think we go lower than originally suspected, that this isn't going to hold, and I think the better level now is a break of 150 in the bond market. Basically the same thing we discussed last night. Nothing's really changed, in my opinion, from the bond market perspective. And the dollar, we're getting the breakout we discussed in the dollar. We got the convincing close above the 93 spot 835, and we closed basically on the highs or near the highs of the day. That tells me, at least for the time being, that this bottom is good and we should see higher prices in the dollar. How high is the question? Well, really the first major level of resistance for the dollar is going to be right around 95.5. So 95.5 will be a pretty decent level of resistance for the dollar. Why is that? Well, there's a couple of reasons. A, you have this chart consolidation here. That's on the daily chart. However, if you go over to the weekly chart and you take a look at where the recent pivot high was and the recent pivot low, and you just do a fib retrace, you can see here that 95 spot 529 is right around that same level. So I have chart consolidation on the daily chart, and I have interesting fib retrace at 382 on the weekly chart. So that tells me that that level is likely to be resistant to the market at least for a few days, if not more. There's really not a whole lot standing in the way of getting to 95.5, give or take. Now, it may not get there in one shot. We may have to, take a stop and consolidate for a while on the daily chart. But all in all, the weekly chart is telling me 95.5 is coming. And with that, I'm going to wrap it there tonight. It's everything I wanted to and intended to discuss. So I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.